There is a man in Ohio, let us call him Marcus, who borrowed $11,000 in 2019. He needed the money fast. His car had died, his job required a commute, and he had two options sitting in front of him: a personal loan from his credit union or the Visa card he had been carrying in his wallet since college. He picked the credit card. It was easier. No paperwork, no approval waiting period, just swipe, solve the problem, move on with life. 4 years later, Marcus still owed money on that decision. Not $11,000, not even close. He had paid back nearly $19,000 in total, and the original balance was still not gone. That is not a predatory loan story. That is not a financial crisis story. That is just Tuesday. That is what happens when you borrow money without understanding the machine you just turned on. And the uncomfortable part, a personal loan, which Marcus dismissed as too much hassle, would have cost him less than half of that. This video is not going to tell you which product is good or bad. Both of them can wreck you. Both of them can be useful. What it is going to do is show you exactly how each machine works, where the gears are hidden, and what happens when you step inside one without reading the manual. Because the difference between a personal loan and a credit card is not just interest rates and paperwork. It is the difference between a fixed trap and a flexible one. And depending on your psychology, your income, and how you actually behave with money, one of them is almost certainly more dangerous to you specifically than the other. Let us start from the beginning. Money has always moved on two rails. There's money you earn and money you borrow. For most of human history, the borrowing side was simple and brutal. You needed something, you asked someone with more than you, and they gave it to you with an expectation attached. Pay it back with a fee. Simple. The modern versions of this arrangement are credit cards and personal loans. They look different, they feel different, they're marketed completely differently, but at their core, they are both the same deal. Someone lends you money, you pay it back. You pay more than you borrowed. The question is always, how much more and over how long? Those two variables, cost and time, are where the story gets interesting and uncomfortable. Let us look at personal loans first, because they're the simpler machine. A personal loan is what finance people call an installment loan. You borrow a fixed amount, you pay it back in fixed monthly payments over a fixed period. The interest rate is set at the beginning and does not change. You know on day one exactly how much this is going to cost you in total. That predictability is the defining feature. It's also the feature most people ignore when they're making the decision. Say you borrow $10,000 at a 12% annual interest rate over 3 years. Your monthly payment is roughly $332. Over the life of the loan, you'll pay back approximately $11,950. The interest cost is about $1,900. You know this up front. It's in the contract. There is no mystery. The loan has a finish line, a fixed, contractual, legally binding finish line. On a specific date, 36 months from now, this debt is done. That structure does something psychologically important. It makes the debt feel real and finite. You can see the end. Behaviorally, that matters more than most people realize, and we'll come back to that. Now, let's look at the credit card. And this is where the narrative gets more complicated, because the credit card was designed by very smart people to be as frictionless and as permanent as possible. A credit card is what is called a revolving line of credit. You have a credit limit, let's say $10,000. You can borrow up to that limit, pay some or all of it back, borrow again, pay some back, and the cycle continues indefinitely. There is no mandatory payoff schedule. There is only a minimum payment, which is usually around 1 to 3% of your outstanding balance, or a flat fee, whichever is higher. Here's what that minimum payment actually does. It's not designed to help you pay off your debt. It's designed to keep you solvent enough to keep borrowing. That's a meaningful distinction. Let's run the same $10,000 scenario through a credit card. Average credit card interest rate in the United States as of 2024 is around 22% annually. That's not a promotional rate, not a subprime rate. That's the average. If you put $10,000 on a card at 22% and you only make the minimum payment each month, here's what happens. You'll spend approximately 27 years paying that off. You'll pay back around $33,000 in total on a $10,000 balance. Read that again. You borrowed $10,000. You paid back $33,000. The bank collected $23,000 in profit from you over 27 years on a single purchase decision. That's not a typo. That's compound interest working backwards, working against you. And this is where the first uncomfortable truth lives. The credit card minimum payment is possibly the most cleverly designed financial mechanism in the modern economy, and almost nobody talks about it plainly. It's the financial equivalent of a leak in your boat that is small enough that you don't panic, but large enough that you're slowly sinking. The minimum payment drops slightly each month as your balance drops, so the amount you're paying also drops, which means the interest charges pile up over time. The math is deeply counterintuitive, and the credit card companies know this. The structure is not an accident.
Compare that to the personal loan. Fixed payment, fixed rate, fixed schedule. At 12% over 3 years, you pay $1,950 in interest. On the credit card at 22% with minimum payments, you pay $23,000 in interest. That is a difference of about $21,000 on the same original amount of money borrowed. Now, you might be thinking, nobody just pays the minimum. Real people pay more than that. And you would be right. Most people do pay more than the minimum, most months. But here is the problem with that logic. Most months is doing a lot of work in that sentence. Life is not a spreadsheet. Your car breaks down in March and you pay less that month. You get a surprise medical bill in June. Your income drops. The holidays arrive, and suddenly you have bought gifts on top of the existing balance. The credit card is always there, always ready, always accommodating. Every time life happens, the card absorbs it and grows. The personal loan does not do this. The personal loan is inflexible. The payment is what it is. You cannot add to the balance. You cannot borrow more without going through the entire approval process again. That inflexibility, which feels like a disadvantage, is actually its greatest protective feature for most human beings, because most human beings are not robots. This is the part of the conversation that financial products do not advertise. The real cost of debt is not just the interest rate. It's the interest rate multiplied by your behavior. And your behavior under financial stress is almost certainly worse than your behavior in a calm, spreadsheet-friendly moment. Personal loans are better at accounting for the worst version of you. Credit cards, in their current form, are specifically engineered to extract money from the worst version of you. Let us talk about the interest rate calculation itself, because there's a detail here that almost nobody explains properly. When you see a credit card advertising an annual percentage rate, an APR of 22%, most people translate that as, "I'm paying 22% per year," which is roughly correct but not fully accurate. Credit card interest is calculated daily. They take your annual rate and divide it by 365 to get a daily periodic rate. On a 22% APR, that's roughly 0.06% per day. Every single day, that percentage is applied to your outstanding balance. Every day, including weekends, including days you don't even think about your credit card. Personal loan interest, by contrast, is typically calculated monthly and amortized on a fixed schedule. The math behaves more intuitively. You know what's happening. The daily compounding on credit cards sounds small, 0.06%, but scale it up over months, over years, and it becomes the engine driving Marcus in Ohio deeper into his hole. Every day he didn't pay his balance down, the math got slightly worse. There's another mechanism hiding inside credit cards that personal loans simply don't have. It's called the grace period, and it's credit cards' best feature and the foundation of a very dangerous illusion. If you pay your entire credit card balance every single month before the due date, you pay zero interest. Not low interest, zero. The bank lends you money for 30 days for free because they make their money from the merchant fees and from the customers who do not pay in full. This is the deal most credit card marketing is built around. Rewards points, cashback, travel miles. These are the advertisements. They are aimed at the people who never carry a balance, the approximately 30% of cardholders that the industry calls transactors, people who use cards as a payment tool rather than a borrowing tool. The other 70%, the revolvers, are subsidizing those rewards. They are the business model. They are the engine. So here is the real segmentation that determines which product is more dangerous for you. Not your credit score, not your income, but whether you are behaviorally and honestly a transactor or a revolver. If you pay your card in full every month before the due date, the credit card is mathematically superior in almost any scenario. You get float, rewards, purchase protection, convenience. The personal loan gives you nothing comparable. If you carry a balance, for any reason, consistently, even occasionally, the credit card becomes a machine that extracts wealth from you at a rate that the personal loan cannot match. Most people believe they are transactors. Most people are wrong about that. Research from the Federal Reserve consistently shows that somewhere between 60 and 70% of cardholders carry a balance in any given month. Not 60% of people who took out a personal loan, 60% of people who believed they were using a credit card responsibly. The gap between who people think they are and who they actually are, that gap is where the wealth destruction happens. Let's escalate the scenario, because so far we've been talking about $10,000 as an abstract number. Let's make it real. It's the United States in 2024. The average household credit card debt is approximately $10,000. The average interest rate is 22%. If that average household is making payments that are slightly above minimum, say $300 a month, which feels responsible, which feels like effort, here's what the math looks like. At $300 a month on a $10,000 balance at 22%, it takes approximately 44 months to pay off. Total interest paid, just over $3,000, which sounds manageable until you consider two things. First, that average household is not paying down a static balance. They're still using the card. New purchases are being added constantly. The balance is not going down. The $300 a month is, in many months, being partially consumed by the interest charges before it touches principal at all. In the first month alone, on a $10,000 balance at 22%, the interest charge is approximately $183. That $300 payment is, in net terms, $117 of progress, not $300. Second, credit card interest, unlike mortgage interest, unlike some student loan interest, is not tax-deductible in the United States. There's no silver lining, no government subsidy, no favorable treatment. You pay 22% after-tax dollars to maintain this debt. There's no offset. A personal loan at 12%, 3-year term, same $10,000, monthly payment $332. Total interest, roughly $1,950. Paid off in 36 months. Done. Finished. No ambiguity. The difference in that scenario is roughly $1,000 in favor of the personal loan, and that's if the credit card holder behaves perfectly, never adds to the balance, and stays consistent. Behavior almost never cooperates with a best-case scenario. Now let's zoom out even further. Let's talk about what financial planners call opportunity cost, because this is where debt stops being just a math problem and starts being a wealth-building problem. Money paid to a bank in interest is money that does not compound for you. It compounds for them. The $23,000 that the minimum payment credit card scenario cost on $10,000 borrowed, If that money had instead been invested in a low-cost index fund, returning the historical average of around 7% annually over the same 27-year period, you would have had roughly $140,000 instead. $140,000 from the $10,000 you originally borrowed. This is the compounding math that gets discussed in personal finance books, but rarely in the context of debt. We talk about compounding as the magical force that builds wealth, but compounding is direction neutral. It builds wealth when you're the investor. It destroys wealth when you're the debtor. And the higher the interest rate and the longer the duration, the faster it destroys.
Credit cards, with their high rates and indefinite durations, are the most potent form of negative compounding available to the average consumer. Personal loans are not benign, they are still debt, but their fixed, finite structure limits the damage to a defined, knowable number. Here's a thought that doesn't get said often enough. The credit card industry is one of the most profitable industries in human history. Not slightly profitable, extraordinarily profitable. In 2023, American banks collected approximately $130 billion in credit card interest and fees from consumers. $130 billion in a single year from a single product category. That number requires an enormous quantity of people who are not paying off their balances, an enormous quantity of revolvers, an enormous quantity of people who either do not understand the math, cannot escape the cycle, or are in a situation where the minimum payment is all they can manage, which is a different problem entirely, one rooted in structural inequality, not personal irresponsibility. But the product is designed to capture all of those people. It is not designed primarily for the disciplined transactor. The transactor is the marketing vehicle. The revolver is the profit center. This is not cynicism. This is product design. Credit cards are a brilliantly designed product. The issue is who they are brilliant for. Let us talk about the access problem because it is real and it matters. Personal loans require a credit check, an application, an approval process, a waiting period, sometimes days. In a genuine emergency, this friction can be a real barrier. Credit cards are instant, present, always available, already in your wallet. For someone with an urgent need and no savings, the credit card is often not a choice, it is the only option. This is the context that makes the credit card versus personal loan debate more complicated than a simple math comparison. Personal loans, despite being cheaper, are not always accessible in the moment they are needed, and the people who most need the cheaper option are often the least likely to have the credit score or the waiting period flexibility that a personal loan requires. The product that most efficiently extracts money from the financially vulnerable is also the product that is most accessible to the financially vulnerable. That structural irony is not an accident of policy. It is the architecture of the modern consumer credit market. For those who do have access to both products, the decision framework is relatively straightforward. If you need to borrow money and you do not know with certainty that you will pay it back within one billing cycle, a personal loan is almost always the financially superior choice. The discipline required to outperform a personal loan with a credit card is significant, consistent, and statistically unusual. If you have an emergency in the next 48 hours and no emergency fund, the credit card bridges the gap. But then the goal immediately becomes take out a personal loan to pay off the credit card balance, trading the high-rate revolving debt for fixed-rate installment debt at a lower cost. Debt consolidation, when done correctly, is exactly this move. It is using the structure of a personal loan to escape the trap of a credit card. Many people discover the personal loan after the damage has been done, as a rescue vehicle rather than a first choice. That sequence is fine. The problem is when people consolidate the credit card debt onto a personal loan, then run the credit card back up again. This is an extremely common pattern. The personal loan fixed the math problem, but not the behavioral problem. Which brings us to the most honest part of this analysis. Wealth destruction from debt is not only a function of interest rates, it is a function of interest rates plus behavior plus time. And behavior is the variable that neither product fully accounts for, but which both products assume. The credit card assumes you will be disingenuous at least some of the time, and it's priced accordingly. The personal loan assumes you will be disciplined most of the time, and it's priced accordingly. If your actual behavior matches the personal loan's assumption, consistent, no additions to debt, full payoff within the term, you win. If your behavior matches the credit card's worst-case scenario, revolving, minimum payments, additions to balance, you lose badly. The uncomfortable question you have to answer for yourself is not which product has a better rate, it is which product matches the honest version of who you are, not the aspirational version. Because the aspirational version of you made a spreadsheet. The honest version of you had an unexpected expense in March, a rough quarter at work, a moment of emotional spending, a season where the numbers just didn't cooperate. The credit card absorbed all of that. The balance grew. The minimum payment continued. Life went on. That's not weakness. That's the human experience of managing money in a system that is not designed to help you succeed with it. The products on offer are not neutral tools. They are products with embedded assumptions about your behavior, and those assumptions are baked into the pricing. Let's bring this back to Marcus in Ohio, because his story didn't end with the $19,000. At a certain point, he started reading. He did the math. He found a personal loan through his credit union at 9.5% over 4 years and used it to pay off the remaining card balance. His monthly payment went up slightly, but the end date was fixed. He could see it. He stopped adding to the debt. 2 years later, the loan is gone. His credit score, which had dipped during the high utilization years, has recovered. He now has a credit card, same card as before, actually, but he treats it as a payment tool. He pays it in full, he gets the miles. The system hasn't changed. The products haven't changed. His understanding of them has. But here's the part of Marcus's story that doesn't get a triumphant ending. The 4 years he spent digging out of the credit card hole were 4 years he was not investing. He was not building retirement savings. He was not buying index funds at a historical 7% return. He was paying 22% interest to a bank. That opportunity cost, the invisible cost, the years of missing compounding on the investing side, is the part of the wealth destruction that never shows up on a bank statement. It is the cost that doesn't have a number attached to it until you run the calculation, and most people never run the calculation because doing so is extraordinarily demoralizing. So here's the final math, the number that nobody wants to see but everyone should see. If Marcus had invested that money instead of servicing credit card debt, if his financial life had taken a different shape from the very beginning, the compounded difference over 30 years, assuming average market returns, is not thousands of dollars, it's potentially hundreds of thousands of dollars. The drag from high-rate consumer debt, compounded over a working lifetime, is one of the most significant and least discussed factors in the wealth gap between people who look similar on paper but end up in very different financial positions at retirement. The credit card didn't just cost Marcus $19,000 over 4 years. It cost him access to what those years of investing could have become. Personal loans are not innocent. They carry interest, they carry fees, they can trap people in cycles of refinancing and consolidation if used carelessly. A personal loan at a high rate, some go up to 36% for borrowers with poor credit, is not meaningfully better than many credit cards. The product category is not inherently virtuous. The structure is simply more honest about what it's charging.